All right, welcome back to my channel. Fury of the Northman. I'm excited. Last couple weeks I've had a hard time staying on my schedule. Went on vacation, work was crazy. I'm going to do a better job this coming month of making sure that my videos come out Monday, Wednesday, Friday, possibly some rant videos in between. But I've been wanting to do this video for a while. I'm going to talk about a concept called chunking the mortgage. It's promulgated by a concept called velocity banking. It's a very aggressive type of banking. It uses debt to pay your debt off faster, to make your money work harder for you. Going to talk about the pros and cons centering mainly around chunking the mortgage. The math is correct on it. I am going to include the link in the description so you can watch the video. Underneath the video that I'm including in the description, there's other videos that break down the math that show you how profitable it is for you concerning paying off the principal faster, which lowers the interest you pay over time. But let's get into the video. So, chunking the mortgage, okay? Last time I checked, $1,000 to $1,500 is right about the amount that you pay monthly. Most people pay for their mortgage. So let's say that your mortgage is $1,500 a month. Okay, let's get to the top. Built into that $1,500 is the amount, it's very infinitesimal, that goes directly to the principal, okay? What chunking the mortgage does is that instead of saving cash, instead of investing money in maybe a Roth IRA or whatever, you decide to make your home a big part of your retirement plan. Before I get into it, I want to say this. By paying off your home quickly, you not only lower the amount of interest you pay, but also too, when retirement comes, if you're going to do what my wife and I are going to do, where we're going to sell the house, we're going to travel, buy a camper or a tiny house or whatever, pull behind a dually, go see America, drive up Highway 1, whatever, right? If you decide to do that, or even if you just downsize and you want to go buy a townhouse, by having your house paid off come retirement, you basically cut yourself a bonus check, okay? And the faster you pay it off, the more valuable that bonus check is, because it's that much cheaper that it costs you to pay the loan off, right? Okay, so $1,500 a month is for your home. Chunking the mortgage, let's say we're starting in January. On top of the $1,500, you also pay $5,000. Now, in the video that I'm going to attach, they use $10,000. You can do what you want. I'm going to go into that later. But how you chunk the mortgage using $5,000 using debt is one of two ways that I've seen. First and foremost, my favorite, credit card, CC. Okay, you swipe your credit card to the lender for that amount of money or whatever amount you choose. That amount goes directly to the principal. Okay. Another way to do it is a HELOC. There's pros and cons to both. I'm going to go over that here in this video as well. But whatever you decide to do, you're putting $5,000 directly to the principal in January. That's the generic month we're choosing. On top of the $1,500. You're no longer saving. You're not putting your money back into savings because you already have your get out of jail free card, if you will, in savings already set aside. I'm going to go into that. But instead of saving $1,000 or $1,500 a month or whatever the amount you can save, you're going to put it into the debt every single month. Because after you pay your expenses, you're going to put that $1,000 or $1,500 or $500 or whatever right back into the debt, right? So let's say for now you're using a credit card, which I think is the better way to go. You get the points, you build your credit twice. What's the downside to this right away that you can see? I'll tell you, it's more expensive. You're not only paying the interest on the mortgage, you're also paying the interest now on the credit card, which is probably somewhere around 28%, right? So it is more expensive. Real quick, I just want to touch on that. Anything in life that's valuable or has value is going to be more expensive. It's going to cost you more. Building a successful marriage, parenting, starting a business, getting healthy and in shape, whatever the case may be, it's going to require more of your time, it's going to require more of your energy, and wait for it, it's going to require more of your money, okay? In the immediate here and now, anything of value is always more expensive. In the long run, it's far cheaper. Good choices tend to be harder to make in the immediate now, whereas bad choices tend to be very easy. But in the long run, a lifetime of bad choices is extremely expensive in the later years of your life, whereas a lifetime of good choices, the later years of your life, it's extremely cheap, okay? So it's God's cosmic joke, whatever the case may be. Here's my point. When I started my business, I have a handyman business, it's extremely physical. Just 3 days ago, I did a landscaping job where I had to tear out a bunch of bushes. They were overgrown. Some of them had some pretty thick roots. I basically had to hack at it with an axe and a hatchet. It's an extremely physical job. I then had to load it in the trailer, take it to the dump. My point is, early on in my business, I realized very quickly that I didn't have the physicality to get the job done correctly. I made a choice to join a gym, to get in better shape so that I could keep up with the demands of my job, which is my business, and I could actually do it successfully without being totally exhausted and having to spend multiple days on one job that should maybe take me a day, right? Maybe half a day, right? But what does that mean? Okay, what that means is this. First and foremost, I had to spend more money. The wife and I had to add $35 to the budget so I could not only have the gym membership of $30 a month, we had to add the $5 so I can get the entrance, after hours key card so I can go when they're open or they're not. So right away it was more expensive monetarily. Guess what? It was also more expensive concerning my time and energy, because for me to do it right, I have to work out in the morning before I even start my business, before I even start my day, which means I got to get up earlier, get my kids up earlier, get them to school, so I can then get to the gym, spend an hour and a half to 2 hours, get a good pump on, then go get my day going, okay? Everything of value in life is more expensive in the immediate here and now. In the long run, it's far less expensive. It's actually dirt cheap in the long run. But for the right here, right now, anything of value that builds upon itself and builds wealth, spiritually, physically, mentally, emotionally, financially, whatever the case may be, it's more expensive. It requires more of you. There's no way around that. You need to accept that. So even though this is more expensive up front, you're getting great benefits, and it's more expensive because you're now paying interest on the credit card, 28%, plus the interest on the mortgage, yada, yada, yada. But you put $5,000 in January directly to the principal on top of that monthly mortgage payment. You then take 4 months, 4M, to pay this credit card balance down to zero. You then start over. You do it again, right? January, February, March, April. In April, you put another $4,000 down. Let's say May. January, February, March, April. Let's say you do it in May. In May, you put another $5,000 down. You've now paid $10,000 directly to principal in this first year, occupying this strategy, using a credit card. What that means is that you've knocked down $10,000 worth of principal that the interest builds upon. Okay, one of the things that our legislators have done well for us is that, contractually speaking, any red cent that we give on top of the monthly contractual obligation, okay, goes directly to the principal. That's one of the things they've done very well for us. That hasn't changed. When you chunk the mortgage, what the small amount that's in your mortgage payment now that goes to the principal, whatever amount you put on top of it, that goes directly to the principal, which over the long haul lowers the amount of interest you pay over the life of the loan. So even though, again, it's more expensive up front, over the long haul, it's actually less expensive, because if you've ever looked at a 30-year mortgage, even a 15-year mortgage, you can pay hundreds of thousands of dollars just in interest. It's brutal, right? So you can avoid the long-term expense by spending a little more money up front to knock that debt down faster. The reason why I like using a credit card above and beyond the points, all that good stuff, is the credit card is an unsecured line of credit. What that means is it's much more difficult for them to come after you if you put $5,000 to $10,000 on the credit card and the mortgage and then you can't pay it for whatever reasons. Let's say COVID-23 strikes, we're in another pandemic, the kill rate's much higher than 0.001% or whatever it is. You can't pay that back. It's much more difficult for them to come get back from you what you spent that money on, because it's an unsecured line of credit. Unlike a HELOC. A HELOC, which is a home equity line of credit, is one of the things that got America, property owners, homeowners in trouble in 07, 08. A HELOC is the equity of the home available to you as basically just a line of credit, similar to a credit card, much lower rate, probably, let's just say 7%. That's probably not right, but it's typically much lower than a credit card. However, most lenders have built into the contract that should you use your HELOC, let's say it's $5,000, whatever, should you use it, if they deem it necessary, they can come and ask that you pay the entirety of the HELOC off in the moment that they demand you do it. Now, there is a payment structure they set up for you, etc., etc. But built into that contract, many times they have that option that's set up for them where they can say, hey, we know you took $5,000 of the HELOC money, the bank's in a bad way, we're going to need all that cash back. Thanks. This situation right here got a lot of people in trouble in the crisis of 07, 08. Because you had property values just keep going through the roof and people would borrow against their home, soaking up the equity of their property entirely in debt. Then when the lender said, hey, we need all that money back, they weren't even close to having the cash necessary or even the ability to pay it back. And that's how a lot of properties went backwards. That's why for me, a HELOC, even though it's cheaper, is really not that good of an idea because, again, if something like a COVID happens and the economy takes a crash or whatever the case may be, you've got yourself on the hook where the lender can say, hey, we need a lot of money back, we need it in 24 hours or whatever the contract says. That's very dangerous. If you decide to do this, I would encourage you to consider, namely, using a credit card. But let's continue. By doing this $5,000 number, in the video that I'm going to attach, the link, they do $10,000, and there's other videos that break down that show the math. The math is correct. This is just a quick overview. Anyways, if you use $5,000 and you pay $5,000 directly to principal every 4 months, that's $15,000 extra a year going directly to principal. That's powerful. That's a lot of money. I've said it before in a very generic mathematical breakdown, that's the right way to say it. Thought a 30-year mortgage with a rate between 3 and 5%, if you just make one extra payment a year, you knock right around 4 years off that loan. Just making one extra payment a year, okay? So imagine making $15,000 extra payments directly to principal. You're going to knock that loan down so fast, it's going to be insane. And again, the value of that is that when you retire, you've basically set yourself up with a bonus check when you can sell your house. Let's move on. The downside to this concept is chunking the mortgage. It comes from Velocity Banking. If I spelled that right. I'm not sure. It's Velocity Banking. It's in the videos. You'll see it. The downside to this is its upside. It's extremely aggressive. It moves really fast. You stop saving your cash, and you really don't invest in other stuff. You just invest in properties, you invest in tangible goods, and you throw it all back into whatever line of credit you're using to chunk the mortgage, okay? So it's extremely aggressive, extremely fast. The downside is this. Excuse me. If you don't have, let's say you're doing $5,000. If you don't have that amount of cash set aside to absolve that chunk should it happens, you're going to be in a bad way. You really are. In all the videos that I've watched on Velocity Banking talking about chunking the mortgage, I've never once heard them talk about having a cushion put back for just in case, okay? If this is something you guys decide to do, you do research for yourself, you like it, whatever amount of money you're going to chunk, make sure you have that in cash that you can pay that line of credit off, whether it's a HELOC or a credit card or whatever. The reason that is because if something like a COVID happens or you lose your job or your income changes, what you're going to want to do is get yourself back to somewhat of a financial equilibrium before you decided to run as fast as you could using the Velocity Banking techniques of chunking the mortgage to pay it down faster. And you want to basically weather the storm of we lost our job due to COVID, the economy tanked, or my job got offshore, whatever the case may be. You want to ride that storm out of just paying the minimum contractual obligations that you owe until you can get back on your feet to where you can pay extra toward the mortgage, okay? If you decide to do this for yourself, make sure you have this amount of money set aside, whatever that is, to absolve that debt should you lose your job, your hours get cut, your pay get cut, or the economy just take a tank in general, okay? That's extremely important. I've never once seen that in Velocity banking videos, but you should definitely do that. Now, here's what's great about it. I've already said it, I'm going to say it again. When you pay your house off, you cut yourself a bonus check, okay, in retirement. The faster you pay it off, the less interest you pay, which means it's the cheaper amount you've paid over time. So you not only paid less money to pay the loan off, you're making the most amount of money possible because you paid on that loan at a lower rate of time, while also, too, getting hopefully the max amount you can when you go to sell it in retirement years. Here's one thing that I also haven't seen the Velocity guys talk about, which I would encourage you to do. It only works if you pay extra on the mortgage. If you don't pay extra on your mortgage, what I'm about to propose to you doesn't work. So you do need to pay extra on the mortgage. But if you're chunking the mortgage, if you're paying extra to it, again, let's say you do the $5,000 3 times a year, that's $15K, right? That's $15K that you put directly to the principal, okay? You would want to go to the bank at the end of that year and see about, because of this, see about refinancing the loan. Again, your mortgage is $1,500 a month. You chunked 3 times a year, $5,000, $15K directly to the mortgage. You really want to go in and look about refinancing the loan. Let's say you're on a 30-year mortgage. You want to go in and talk and say, how much would the monthly payment be if I refinanced it for another 30? They say, yeah, no problem. Wow, you put $15,000 down directly to the principal. That's amazing. If you refinance the loan, instead of $1,500, it's going to drop to, wait for it, $1,200. Now, the downside to this, just jumping off topic real quick, just like with paying with a credit card, just like with getting up earlier to get in shape, it's more expensive. Why? I'll tell you. Every time you refinance your home, you pay closing costs. Okay? Again, anything of value always costs more time, money, energy, whatever in the immediate now. But in this scenario, your new contractual obligation, this is the original contractual obligation, the OCO, right here. In your new contractual obligation, you now have a $300 surplus that's available to you. Don't keep it. Put it right back into the asset. And you're still going to chunk $5,000 3 times a year. Here's what's exciting. $300, 300 times 12 is $3,600. $3,600 plus $15,000 is now $18,600. Okay? In the second year, you've now paid $18,600, and in 2 years' time, you've paid over $33,000 in interest in 2 years' time. Okay? What I like most about it, as great as that is, the combo of this, you got the cash surplus, is that in the event of a worst case scenario, let's say you can't chunk the mortgage. Let's say you can't even make extra payments. It's okay. You've lowered the contractual obligation. You've lowered the amount of money you have to pay to keep the note current so the house doesn't go backwards, so the property stays yours. This is kind of an oversimplification, but I think it needs to be stated. Whenever you borrow money to buy a property, you are a partner in that property with the lender. And unless you pay it off as fast as you can, and unless you keep refinancing to restructure the loan for yourself, to make it better for you in the event that something goes wrong, they have all the cards. Fact, there's no way around it. If you don't make the payment, they assess fees, they end up taking it from you. It's tragic, it's the way it is. The point is this. By refinancing every so often, again, it only works if you're paying extra, you can lower the contractual obligation but continue to pay the OCO, the original contractual obligation, which is that much money going to the principal. So let's say this is the first 2 years. Let's say in the third year, you pay $1,500 a month. You pay another $18,600. I think that math's right. In 3 years' time, You've paid $37,200 plus $15,000. You've paid over $50,000 directly to the principal in 3 years' time. You go back again. Hey, Chase. Let's say Chase is the bank. Hey, Chase. What if I refinance my house for another 30 years? What would that payment be? Well, let's take a look. Oh my gosh, in 3 years you paid over $50,000 directly to the principal? Holy cow. We can redo the loan. We don't got to do that FHA anymore. We can get rid of that PMI, that mortgage insurance. Your mortgage is going to drop to $700. That's amazing. You've done a great job. This is the new contractual obligation. Right here. This is the new dollar amount you have to hit every month to keep the note current. You continue to pay $1,500. Okay? You're still chunking the mortgage $5,000 3 times a year. In that 4th year, you would have paid $9,600 on top of the $15,000 directly to the principal. That means in the 4th year, instead of $18,600, 15 plus 9, you paid $24,600 directly to the principal. And you never changed your payments. You never did anything different. That's what's amazing about this concept. That means in 4 years' time, you've paid almost $80,000 directly to the principal. That would be, if it's a $200,000 house that you bought, that means in 4 years' time, you've paid almost 50% of the house off. It works, guys. The math's real. I mean, you're going to see in the videos, I know it sounds crazy. All of the most important advancements in human history when they first were talked about sounded crazy. I'm telling you guys it works. Chunking the mortgage is amazing. Pay your house off, cut yourself a bonus check, save the money on interest. It's a better way to go. If you've liked the content, like, share, subscribe, leave a comment. If you hated it, send it to someone you hate. I'll see you Wednesday.